So there's this one stock that I've been kind of keeping an eye on. I think it's getting interesting, even though I do think the consumer is slowing down. This is a consumption type of stock, and this stock has fallen off of a cliff, going from nearly $300 a share all the way down to the low 60s. Currently trading at $66, basically trading at a multi-year low here. It's down roughly 35% on the year. Now, if you're not familiar with Etsy, the thing that you gotta like about Etsy is that it's all handmade, unique items that you can find, everything from furniture to clothing, which kind of makes it uniquely positioned here. One-of-a-kind type items that you can search for and buy, but the e-commerce business has definitely gotten way more competitive, and Etsy's price is reflecting that. So now the question becomes, at what point does Etsy become a buy for us? And we always build safety in our analysis, so let's get into it. So we just take a quick look at sentiment around Etsy. You have everything from $50 a share to $157. Current PE is just sitting under 30, while the forward PE is sitting right around 25 times. Which for a small cap growth company is actually not too bad here. Now, what made me kind of put Etsy on the radar is obviously it's sold off from a significant level where we have to start looking at it and wonder, is there any value in this stock? And when I look at top line revenue growth, this is a company that is still in the growth phase here, going from $440 million of revenue in 2017 to 6 years later doing $2.7 billion of revenue. Very impressive top line growth. Now, as we always say on this channel, price will follow EPS growth. And we can see here that EPS growth was very, very nice in an upward trend, almost predictable type of trend. And then all of a sudden, an absolute collapse. It's starting to kind of regain its footing here and getting EPS back on the right track. Now, we can see here that margins are kind of all over the place. They were doing roughly high teens pretty consistently. Jumped up to 27% margins, 23% margins, then a huge hit of negative 21% margins. Because they had a huge operating expense, this caused 2022 to be kind of a wacky year for them. But as of 2023 and going forward, it looks like operating expenses are going to be under control here. But what I do want to point out and make clear is that I do think margins are going to be a topic of conversation. As this landscape has gotten more competitive, I think we have to be a little bit more cautious on our margins. This is also a company that demonstrates pretty strong free cash flow here. Roughly 20% free cash flow margins, which is extremely powerful. They've done a good job getting 15.9% return on invested capital. And when you look at the fact that they have $1 billion in cash and roughly 2.3, call it 2.4 billion in debt, this is a company that can cash flow pretty strong. Yeah, I don't see any issues with the balance sheet here. I actually think it's a fairly strong balance sheet overall. So just by a quick glance here, I'm seeing that strong balance sheet, good return on invested capital, still in a growth stage. Now the question becomes, what kind of growth rates do we want to put on this stock? And that's where we're going to kind of lean on the experts' analysis here to see what they're projecting out. And we always build safety in this analysis, especially if we're leaning more towards the pessimistic side that the consumer will slow down soon. So stock analysis has them growing 5, 7, 8, 18, 15%. I think it's really hard to project out what 2027 and 2028 are going to be. But I think using that, 7 to 8% growth rates makes a lot of sense because this is a company that's proven to kind of do that. But the growth rate is slowing down, so we want to keep that in the back of our minds. Now, the one thing I really do like about this stock is that I thought it was overpriced not that long ago, but as valuations are coming down, the company is actually growing its revenue. And this is definitely where I think you can find some opportunities within the market. Analysts on Yahoo have them growing 22% going forward over the next 5 years. Definitely not getting behind that, but I can get behind a little bit more. Maybe 8 to 9% is about where I'd be looking, kind of keeping it more in line with stock analysis. One thing I want to point out about the company is that they had 125, call it 126 million shares outstanding. That's down to roughly 119 million shares outstanding. When we look at a multiple of EBITDA, definitely trading for a premium to its peers, as I think it should trade at somewhat of a premium because this is a clean balance sheet. This is a company in still the growth phase. And so there is some big opportunities with a smaller cap company like Etsy. Now, I'm just going to plug in numbers to see if this is a company I'm going to dig more into. So this is kind of the surface level scratching that I'm doing about a company. The price has fallen. The price has absolutely collapsed, but yet the revenue is still growing, and it looks like EPS is starting to head back in the right direction, which means there could be an opportunity here. But now we're going to start plugging in the numbers, see what a price projection is going to be, and see if this is a company worth digging more into. So here's what I want to point out really quick, because when I'm looking at a multiple to EBITDA, I think it's a little bit off here. When we look at where Shopify is trading at on a multiple to EBITDA, I definitely think I can get behind Etsy trading closer to 16 to 17 times of a multiple to EBITDA. And so we get two price targets here. We get $44 and almost $60 from a free cash flow standpoint. So I'm going to put Etsy between $45 to $60 price target. And so it's actually getting into an interesting zone here where I think if it breaks below $60 a share, you have a pretty interesting stock here. But understand that, of course, this is just my analysis and me scratching the surface. I definitely have to dig into more, because where I could be missing the opportunities is going to be in two areas. Number one is going to be, can this company actually grow in the double digits again? And number two is, can they expand margins again? If this company can grow closer to 9 or 10%, then you're probably looking at a company that is most likely a buy right now. As always, guys, really appreciate your time, and we will see you in the next one.